If you're invested in the Big Time Income ETF, JPI, you probably love seeing that monthly deposit hit your account. But I bet you've also noticed something a little weird. Some months it's a great paycheck. Other months it feels like you took a surprise pay cut. Well, today we are going to pop the hood on JPI and figure out exactly why that paycheck is so wobbly, and more importantly, what you can do about it.
So let's just dive right into the big question. You open your statement and the income from JP is kind of all over the map, right? One month feels great, the next one's down. So you start to wonder, hey, is my fund broken? Did somebody mess up? And you know what? Those are exactly the right questions to be asking, especially if you're counting on that cash flow.
And this isn't just in your head, it's very real. Just look at this recent stretch. The payout went from 54 cents a share in June, and then it plummeted to under 36 cents by August. I mean, that's a 33% pay cut in 60 days. Can you imagine if your boss did that to your salary? This is the wobble we're talking about.
But here's the big reveal, the most important thing to get your head around. Your fund is not broken. That wobble, it isn't some kind of glitch. It's actually a feature. It is fundamental to how JPI makes its money. To really understand why, we've got to look inside the machine.
Okay, first things first, let's break down exactly how JPI's income engine works. You can think of it like a hybrid car. It's got two different power sources, and understanding both is the key to solving this whole mystery. So imagine JP has two engines chugging along at the same time. The first engine is pretty simple, right? It owns a bunch of stocks, and those stocks pay out dividends. That part of the income is actually pretty stable. But it's that second engine, the option premiums, that's where all the horsepower is. And yep, that's where all the wobble comes from too. Now, JPI gets that option income from something with a fancy name, equity-linked notes, or ELNs. Don't worry, don't get bogged down in the jargon. Just think of an ELN as a handy shortcut. Instead of the fund managers having to juggle thousands of really complex option trades themselves, they just buy these pre-packaged notes from big banks, and the banks deliver the profits in one tidy bundle. It's all about making things efficient.
And the price of those options, the amount of income they generate, is basically tied to one single thing: implied volatility. Seriously, if you understand this one concept, you're going to understand the entire JEPI wobble. Implied volatility is just the market's best guess of how much prices are going to bounce around. The easiest way to think about it, it's the stock market's fear gauge.
And this chart right here shows you the whole relationship, plain and simple. When markets are calm and everything's chill, fear is low. Nobody's willing to pay a lot for insurance, so those option premiums are cheap. The result? Your JPI check is smaller. But when the market gets crazy and choppy, fear skyrockets. Everybody's scrambling for protection, so they'll pay a high price for it. Those option premiums get expensive, and boom, your JPI check gets bigger. That's it. That is the entire reason your paycheck changes month to month.
Okay, so now we get the wobble. It's all about fear in the market. But there's a second piece to this puzzle, a little surprise that usually doesn't show up until you're doing your taxes. Turns out, not all of that income JEPI spits out is created equal in the eyes of the IRS.
And this is just wow, it's a really crucial detail. Looking at the numbers from 2023, a massive 80% of the money JIPI paid out was classified as ordinary income. What does that mean? It means the vast majority of your distribution gets taxed at the same high rate as your job's salary, not that much lower, friendlier rate that most stock dividends get. So, the bottom line is pretty simple. If you're holding JEPI in a regular taxable brokerage account, that big, attractive yield that you see advertised, well, it's going to take a pretty serious haircut from Uncle Sam. Your real after-tax return could be a lot lower than you realize. So, we've got a wobbly payout and a potential tax headache. With all that in mind, how in the world do you decide if JFBIPI actually makes sense for your portfolio? Well, it really all comes down to understanding one really important distinction. People love to use the words stable and predictable like they're the same thing, but when it comes to JP, they mean two totally different things. JP can offer a pretty stable income if you zoom out and look at the whole year. The total amount of cash you get annually might be fairly consistent, but what it does not offer is predictable income. It will not, cannot give you the same dollar amount every single month, and that is the central trade-off you're making. So who is this actually for? Well, it can be a fantastic tool for a few types of investors. First, for anyone who's holding it in a tax-advantaged account like an IRA or 401k, that completely solves the tax problem. Second, it's great for disciplined budgeters, people who can keep a cash buffer to smooth out those bumpy months.
And third, for investors who are just looking to diversify their income streams, maybe putting it alongside some more traditional bonds.
But let's be just as clear about who this is probably not for. If you absolutely need a specific fixed amount of money every single month to cover your mortgage or your car payment or other essential bills, then relying on JPI all by itself is a recipe for a whole lot of stress. It is simply the wrong tool for that specific job.
Okay, but what if JPI does seem like a good fit for you, and you just want a way to tame that wild, wobbly income stream? Well, the good news is you can. There's a really practical strategy you can use to basically engineer your own predictable paycheck from it.
Here it is. It's a simple 4-step plan. Step 1, if at all possible, hold it in an IRA to get rid of that tax headache. We've covered that. Step 2, set up what's called an income bucket. This can literally just be a separate savings account. Every single JPI distribution goes directly into this bucket. Step 3, you pay yourself a fixed, conservative dollar amount out of that bucket every month. And step 4 is where the magic happens. In those big payout months, the bucket builds up a surplus. And then you use that extra cash to cover the difference in the low payout months. You're basically creating your own smooth, steady paycheck.
Whew, okay, we have covered a ton of ground. So let's just boil it all down into one final honest scorecard to make sure these key takeaways really stick.
So here we go. Predictability? It gets a low rating. Your monthly check will change. Period. The payout level? That is totally volatility dependent. You'll get less when the market is calm. Tax efficiency? We gotta say poor if it's in a taxable account. This thing is really made for IRAs. And finally, total return? It's moderate. By its very design, it's going to lag when the stock market is having a massive bull run. That's not a flaw, that's the trade-off it makes for that income.
And all of this brings us to the final and honestly the most important question of all. The question isn't, is JEPI a good fund or a bad fund? That's the wrong way to think about it. The real question you need to ask yourself is, do I need income or do I need predictable income? Answering that one simple question will tell you everything you need to know about whether JEPI has a place in your plan.